Hey everyone, my name's Adam. My partner Caleb and I did a comparison between the New York and Tokyo stock exchanges, and these exchanges are good examples of how globalization has connected the world. Now companies are cross-listed in multiple indices across exchanges around the globe. So it's important for investors to understand these foreign exchanges to diversify and capitalize on growing international economies. So this presentation is going to serve as a comparison between Tokyo and the New York Stock Exchange, comparing their histories, offerings, listing requirements, the key indices, the S&P 500 and the Nikkei 225, as well as some performance measures over some key global events. So the United States is actually responsible for two of the largest stock exchanges in the world. First being the New York Stock Exchange at a market cap of 16 trillion. Second, the Nasdaq, and third, Japan's exchange group, the Tokyo Stock Exchange, which we'll get to in a minute. But some brief history on the New York Stock Exchange. It was founded in 1792 via the Buttonwood Agreement to eliminate the need for auctioneers used frequently for wheat, tobacco, and other commodities. In the early 19th century, New York became the financial capital of the United States and the world, quite frankly. As the New York Stock Exchange started selling government bonds and bank stocks, over time the exchange became one of the biggest driving forces in the United States economy. And I think a testament to that is that the first major crash of this stock market in 1929 triggered the biggest economic depression in modern history. So the SEC got involved to regulate the exchange as a result, and to just bring back consumer confidence into investing. And in 2008, the American Stock Exchange, a mutual fund-based exchange, worked in tandem with the New York Stock Exchange to help make investing in companies commonplace. And so now it's the world's largest stock exchange. At $6 trillion, the Tokyo Stock Exchange is the third largest exchange in the world, as I mentioned, by market cap. It's about 100 years newer than the New York Stock Exchange, founded in 1878 by two Japanese businessmen. In the 1940s, the exchange was combined with 10 other Japanese exchanges, gained competitiveness to form the Japanese Securities Exchange. In 1940, in the 40s, of course, the Nagasaki bombings shut down the Tokyo Stock Exchange until it reopened in 1949. 1 year later, the Nikkei 225 was introduced. That's in 1950, and it was calculated by a Japanese financial newspaper. In 2005, there was a big typing error that I think it's a little fun story to talk about, so I included it. One trader from a reputable Japanese firm mistakenly sold 600,000 shares for 1 yen instead of one share for 600,000 yen. And it cost the company $225 million and actually contributed to a 1.95% correction in the entire Nikkei index. And it points to some of the flaws in automation, I guess, at the time. So, new steps were put in place to regulate that and prevent that from ever happening again. And then in 2011, the TSE merged with their competition, the Osaka Securities Exchange, to become the world's third largest exchange and expand their offering to compete with the rest of the world in the New York Stock Exchange. Now for some offerings on the New York Stock Exchange. They have many investment opportunities, including equities, options, exchange traded products, and bonds that help people cater to their investment needs. So the biggest blue chip stock on the New York Stock Exchange is Berkshire Hathaway at $523 billion. Some other popular blue chips are Visa, ExxonMobil, Johnson & Johnson. For options, index equity, Flex and Leap that offer some customization. The exchange traded funds. And then bonds, convertible bonds, debt bonds, corporate bonds, dual currency bonds. Basically, there's so many offerings, and it's a lot of the same on the Tokyo Stock Exchange, except, so I'm not going to go over that again, but one main difference between the exchange is the different trading hours. In Tokyo, stocks are traded from 9 a.m. to 11:30 a.m. and then from 12:30 p.m. to 3 p.m. So between the hours of 11:30 and 12:30, there's a break in trading, making the New York Stock Exchange open for 30 more minutes of daily trading a day. And it gives breaks for traders to eat lunch and doubles as a circuit breaker to split up large movements in the market. In 2011, Tokyo extended its trading day by cutting what was an originally 90-minute break into its current 60-minute break to compete with other Asian and international exchanges like Hong Kong, who would later also shorten their break too. But on the Tokyo Stock Exchange, I decided to break it down to their different listing tiers, that being the first and second section, Mothers, JASDAQ, and the Tokyo Pro Market. In the first and second section, this is what's called the main market. It handles the bulk of the trading volume. It's characterized by high liquidity, high volume, a lot of foreign companies, basically where you would be trading in the Tokyo Stock Exchange, probably. And then there's Mothers, that has no size restrictions. It's reserved for growth companies. And the goal of companies that get listed in Mothers is to get reassigned to the main market, the first and second sections. The JASDAQ, it has three characteristics: one, reliability; two, innovativeness; and three, region and internationalization. And this is split into the standard market and the growth market. And then finally, the Tokyo Pro Market is a joint venture between the Tokyo and London exchanges, and it provides additional opportunities to compete and to compete globally, again, with the New York Stock Exchange, namely. To get listed on the New York Stock Exchange for a company to IPO, it needs to have at least 400 shareholders, market cap of at least 40 million. That's 1.1 million public shares outstanding at a share price of at least $4, according to their website. They also have to be profitable at the time of listing, and there's an earnings requirement. That's 10 million over the past 3 years, 2 million of which must be earned over the past two. There's more strict requirements on international trading of 5,000 plus shareholders and 2.5 million public shares outstanding. So to IPO on the Tokyo Stock Exchange, a company needs to meet specific listing requirements for each of the categories, and you can see here, first, second tier, Mothers, JASDAQ, they all have different net profits, revenues, assets, market cap, and then over here, there's a different shareholder requirement too. Generally, speaking of the main market, they have to have, you can see here in the second section under the main market, 800 or more shareholders compared to just 400 on the New York Stock Exchange. And then there's also a lot of, maybe I would call ethical requirements, or just making sure it's a sound company overall, that corporate continuity and profitability. Again, these are requirements on the New York Stock Exchange as well. It's a little bit different in the Tokyo Stock Exchange. Soundness of corporate management, the list goes on. I think in total, it seems the Tokyo Stock Exchange has tougher requirements. For a company to IPO in the main market, for instance, they need to be larger and have more profit, and it holds true for most of the markets. Additionally, companies on the Tokyo Stock Exchange need to have, like I said, more shareholders compared to the New York Stock Exchange. And now for the sectorization of the key indices on either of the exchanges: the S&P for the New York Stock Exchange, and then the Nikkei 225 for Japan. Both of the industries, they're similar in that it's basically just a combination of the biggest blue chip stocks traded on that exchange, but there's 500 of them in the S&P and 225 on the Nikkei. But the biggest difference is that the S&P 500 is a market cap weighted index, and the Nikkei is a price weighted index. Because the Japanese index isn't market cap weighted, its sectorization may not represent the actual sectorization of the Japanese economy as the S&P 500 does for the United States. For example, the largest component, fast retailing Ltd, makes up 11.2% of the whole index, the Japanese index. And the Toyota Motor Corp, the biggest stock based on market cap, makes up just 1.2%, despite being more than 4 times larger and more valuable than faster retailing. But we can still compare the two sectors with this chart here, and see that the S&P 500, it's dominated by information technology at almost 20%, and then for the Nikkei, the top is consumer discretionary, then industrials, but information technology is still a key component of the Nikkei. We can see that the S&P 500 is generally more spread out, so probably less risky than the Nikkei 225. And just considering how either economy has been doing in the last couple decades here, S&P is probably a better investment. But if you add up the smallest four sectors of either economy, you can see too that it makes up such a more significant percentage of the total sectorization of the S&P 500 versus of the Nikkei. A couple key differences. The consumer discretionary, just barely almost 10% of the S&P 500 versus over 20% on the Nikkei 225. And where will this go? Well, because of the coronavirus pandemic, we might see a shift away from that consumer discretionary, and I think a lot of people are wishing that they had a little more allocation into utilities and materials and stuff. And as far as materials go, the Nikkei actually does compared to the S&P 500. So I would say the S&P 500 is a little less risky compared to the Nikkei.
So now we'll start with the long-term comparison. As you can see, since 1980, the S&P has grown over 2,500%, whereas the Nikkei 225 has really lagged and has only grown around 190%. A few things to point out on this graph is in 1990, you can see a quick peak of the Nikkei 225, and this was due to the Japanese asset bubble, which I'll address in the next few slides. And so moving on, you can see over the past 3 months, there's been a positive correlation coefficient of the two indexes of 0.97. So they're both really positively correlated currently. But in the same time, the Nikkei 225 has been 1.52% times less risky than the S&P 500, which, as you can tell, from finances, the more risk, the more leverage, which means the more opportunity for gains as well. So that's why the S&P has outperformed the N225 throughout the past decade and beyond. But despite these two indexes tracking together over the recent times, it's really been a struggle after 1991 when when the Japanese economy really peaked. And the Nikkei 225 is actually down since its peak of 15.8% since that year, while the S&P is actually up 700% in that same time. So now I'm going to talk about the last decade, which was the peak of the N225 in 1990. And this was due to the Japanese asset bubble, which I talked about earlier. And this asset bubble was caused by a quick acceleration of asset prices, as well as heavy economic activity, which then was compounded by the fact that the government was putting into place a lot of monetary easing policies, which caused consumer sentiment and overconfidence regarding these asset and stock prices. So this led to a major drop in the N225, as you can see below, whereas the S&P 500 really showed little to no effect from this bubble. And in a study done by the Fed recently, it was determined that before the bubble occurred, the Japanese GDP was doubling every 14 years or so, whereas post-bubble, it's currently doubling or should double every 80 years. So now I'm going to move towards early 2000 and 2001 and the two major events. So starting with the dot-com bubble, it was an excessive speculation and overvaluation of internet-based companies that led to a bubble that burst in 2000. So this really affected the economy on a global scale, but you can see the S&P in purple and the N225 in blue, making a bigger drop off. And actually, it really didn't affect the S&P as much as some would think. And this could be due to the recent lagging and struggles of the Nikkei, as well as the Japanese economy up to this point. And I also added in the NASDAQ composite in pink, which really illustrates um, how big of a drop tech stocks took. Some blue chips actually losing up to 80% in value during this time. And you can really see this in the NASDAQ composite because it was so heavily weighted towards tech stocks that its highs and lows were much greater than those of both indexes that we're looking at. So you can see how large this disproportionately affected the IT sector of all markets. And then in 2001, you can see that all markets really took a drop during that time. So moving on to, so now I'm going to talk about 2007 and the 2008 financial crisis. So starting in early 2007, there was an unexpected sell-off in the Chinese markets, which led to a steep decline in both indexes. But the S&P was able to rebound a lot quicker than the Nikkei 225, when that was due to the fact that the Nikkei has a lot stronger ties to the Chinese markets. And moving on towards 2008, after both indexes were seen to be making a lot of progress since hitting lows in the dot-com bubble, the indexes took a sharp turn for the worse as the S&P actually dropped 60% from its record high to around $638 in just 1 year. But in the week after the financial crisis really started to occur, the S&P fell 28%, whereas the Nikkei took an even greater initial drop of 36%, which is really interesting given the fact that, most would assume that the American markets would be affected a lot greater. So now moving on. So now here we are at present day. Coronavirus has really forced its way through the markets, and now we're living in a financial crisis. So what is going on? Well, both indexes are really tracking very similarly during this time. But as you can see, the S&P has been a lot more volatile. As I brought up earlier, it's just there's greater risk in the index. But recently, the S&P hit record highs just 2 months ago of around $3,500. And since then, the index took a 33% drop in just 1 month. During this fall, there was actually a drop, which was the third worst single day performance in the history of the S&P, which was on March 16th, and that was a 12% drop. A week later, actually, the markets hit a bottom, which many economists actually hope and believe won't be hit again, but that's just due to the number of the coronavirus plateauing a little bit in the U.S. Other factors weighing in on this turn from the bottom is the Fed's unwavering support of the economy with stimulus packages being put in place, as well as investor sentiment changing, which has been changing pretty much every day. And this has led to a 25% climb in the S&P since it hit its low, led most by the major tech stocks, so Apple, Facebook, Google. Some are saying this optimism is shortchanged because of the fact that we believe the economy is reopening. However, there's a lot of doubt around how it's going to open and the circumstances surrounding that. And then looking at the Nikkei during the same time, it looks very similar. However, it hit its low actually 5 days prior to the S&P 500, which really could be due to the fact that the virus was seen in Asia a lot earlier than in the U.S., so the effects weren't seen as quickly. But despite the difference, the two indexes have still followed pretty much the same pattern. In recent days, around April 7th, there was a stimulus put into place by Japan. And since it hit its low, it's rallied around 17%. So both indexes have been climbing, with the S&P being greater of 25%. However, analysts are still hesitant to say that we're exiting a bear market just because there's so much uncertainty. And so you can see from the chart in S&P that there's multiple factors that have been changing the market, such as the travel restrictions with the stimulus package as well as the other stimulus package. But it seems to be moving away from the record low, which it hit March 21st.